This is a book review of Common Stocks and Uncommon Profits by Philip Fisher. This happens to be one of Warren Buffett's favourite books on the topic of investing. The philosophy that the author of this book puts forward is really about finding growth opportunities, identifying companies which have great potential and prospects going forward. So rather than taking Benjamin Graham's approach, which is to try to find value and to try to find businesses that are underpriced or overlooked by the market, this book is more about identifying companies which are innovative, which have great R&D, which have competitive edges, which have growing revenue, increasing sales in developing industries. And the author of this book gives a 15-point checklist to help the reader gauge and decide whether or not a particular company looks like a future prospect. The first two of those points that the author offers the reader is looking at the income and the revenue and the sales. And Philip Fisher in the book asks the reader not to look at one single year or even 2 or 3 years, but really to consider how the sales have increased over a long period of time. And secondly, to inspect the company further and ask the question, is the company in the process of developing new products, goods or services that are going to expand and grow the business and offer customers new things? And the main argument here is that because it's a competitive world and companies are innovating all of the time, technology is constantly being improved, companies need to constantly evolve, adapt, and be looking with a long-term view. They need to maintain a long-term view and try to look beyond the current horizons and develop products which customers are going to want 5-10 years into the future. Other principles on that 15-point checklist also include looking at the management. The last principle is asking the question, can the management be trusted? Are the management of integrity? And he tries to encourage the reader to look at the honesty of the board in terms of, do they always try to present the rosiest picture possible? Are they unduly optimistic? Or do they also point out areas that need to be improved in the business and that the company is trying to address going forward, so that there's some sense of realism and the board have the shareholders in mind? It's not about trying to pull the wool over the eyes of potential investors. He gives you another 12 rules, another 12 criteria, which you can read about in the book. And this should help the reader discern from, all the hundreds of possible prospects, which ones are more likely to succeed in the future. He also gives other more general tips on what to look for, what not to look for. He is not really a big fan of dividends, for example, or rather, he doesn't necessarily think it's a big problem if a company doesn't pay dividends, because his argument is that the company might be using the money wisely to invest in the business, to grow the business, to improve products and services, to improve the marketing and sales of the goods that the company sells. And so it's not necessarily a negative if the company isn't paying a high yield dividend. He gives you some other things to look out for, and as I said right at the start of the video, this is a book that Warren Buffett has frequently recommended, and it came out in 1958, so it would be of interest to anyone studying business, finance or economics, because there's a lot of value in reading a book that was written 70 years ago, in the sense that you can get a better, deeper, broader understanding of the historical development of the stock market and how the business environment has changed and how various laws and things have evolved over the years. So I'll leave this book with you today. It's called Common Stocks and Uncommon Profits. Do go and check it out. Thank you very much.